Should you tap into your investment portfolio to delay claiming Social Security? It's a question that many retirees have, and the decision can have a big impact on your long term financial stability. In today's video, we'll explore the pros and cons of using your portfolio to delay Social Security and whether it's the right choice for you. Hi, my name is Zach Carruthers, and welcome to the channel. If you're planning your retirement and wondering whether it makes sense to delay your Social Security, then you are in the right spot. In this video, we'll look at the benefits, the risks, and the things that you need to consider before making this decision. Let's go over how Social Security works. For the sake of this video, you're going to need to know that the earliest you can file for Social Security is at the age of 62, and doing so will reduce your monthly payment forever. Now, if you wait until your full retirement age, which depending on your date of birth is either 66 or 67, you will receive your full benefit, which is your full primary insurance amount. And if you elect to delay until the age of 70, you're going to earn 8% per year past your full retirement age. This will also increase those monthly payments over your lifetime. So the question is, should you use your portfolio to bridge the gap and delay filing for Social Security? Well, in today's video, we'll cover the following, which should help you answer that question. Number one, the pros of delaying Social Security. Number two, the risks of drawing down your portfolio early. Number three, how taxes play a role in your decision. Number four, how to assess your cash flow needs. And number five, the break-even point. So let's dive into point number one, the pros of delaying Social Security. As briefly mentioned, by delaying your benefits past full retirement age and up to the age of 70, you'll receive the maximum monthly benefit plus 8% per year from full retirement age up until the age of 70. If we assume that your full retirement age is 67 years old, that means you will receive 100% of your primary insurance amount at the age of 67. At the age of 68, you will have 108% of the benefit that you would have received at full retirement age. At the age of 69, you will have 116% of the benefit that you would have received at full retirement age. And at the age of 70, you will receive 124% of the benefit that you would have received at full retirement age. So as you can see here, these larger payments can significantly increase your monthly benefit amount from Social Security. That is those percentages that we just covered. For example, a $2,000 monthly primary insurance amount at full retirement age could be, $2,480 if you were to delay it until the age of 70. So, should you delay collecting Social Security until the age of 70? Well, there's much more to consider outside of this primary insurance amount. That is the benefit that you will be receiving. So, yeah, you could elect to delay filing for Social Security until the age of 70 and collect that larger check. But let's consider a couple other things. What happens, for example, if you're in bad health or you have a family history of passing away early? It might be more advantageous for you to actually file earlier. Or what if you need the money today, right now? Maybe you fear that Social Security won't be able to meet all of your needs in the future. So you might as well just start collecting today. Now, on the flip side, if you expect to live a long retirement, then maybe it's more advantageous for you to delay claiming until the age of 70. We will break this down in more detail when we cover the break-even analysis, point number 5. So what's the takeaway here? Well, the takeaway is it's really important for you to understand your unique situation and how collecting Social Security impacts your overall retirement plan. Now, on to point number 2, the risks of drawing down your portfolio early. As we just briefly mentioned, While delaying Social Security can seem like a great strategy, after all, who doesn't want that larger monthly check? It comes with a significant trade off that is often overlooked. In the meantime, you'll need to rely on your investment portfolio to cover your basic living expenses. Sounds manageable, right? Well, here's where the risk comes in. Using your investments as income, especially if you're not ready to tap into Social Security, can expose you to some serious risks, particularly in volatile markets. Think about it. If the market takes a downturn while you're pulling money from your portfolio, you could find yourself depleting your savings much faster than you had originally planned. This scenario is known as sequence of returns risk, and it's something that many retirees just don't see coming. In fact, sequence of returns risk can directly lead to longevity risk, which is the danger of outliving your money or running out of money too soon. Now, this is concerning because what happens if you need these assets later on in retirement? Perhaps in your 80s or 90s. Well, as I'm sure you could imagine, at this stage in life, it's much harder to build up those savings, and you have way fewer options in replenishing your savings. And if you've already depleted too much of your overall portfolio, those assets might not be where you actually need them to be. So let's also keep in mind that it's not just about how much you're withdrawing. It's also about the timing of those withdrawals. The timing of your withdrawals can dramatically affect the longevity of your portfolio. If the markets are down and you're forced to sell those investments to cover your basic living expenses, you're locking in those losses, which means that you might never fully recover from that market downturn. So, while delaying Social Security today could boost your future benefits, it's essential to weigh the potential risks carefully, this being one of the top risks. You don't want to jeopardize your financial future by tapping into your savings at the wrong time to fund your lifestyle. Balancing the timing of when you claim Social Security and when you draw from your portfolio is key to your overall retirement plan and ultimately that withdrawal strategy. Now, let's talk about something that often gets overlooked when making decisions about delaying Social Security. Point number 3, the tax implications. When you start tapping into your investment portfolio to cover living expenses, the reality is that you're going to face taxes on those withdrawals. And the tax impact might be a lot bigger than you had originally thought. If you're pulling funds from a traditional IRA or a 401k or any tax deferred account for that matter, here's what happens. Those withdrawals are considered taxable income. That means every time that you take money out of those accounts, the IRS is going to want its share. And the amount of tax that you owe will depend on your total income for that particular year. In other words, the more that you withdraw, the higher your taxable income, which could push you into a higher tax bracket if you're not careful. And here's where things get even more interesting and more complicated. When it comes to Social Security, while your Social Security benefits are also subject to taxation, the rules around how much of your benefits are taxed can get a little tricky. It's not just about how much you earn from Social Security, it's about your overall income picture. If you have other sources of income, say part time work and wages, and the money that you'll be withdrawing from your IRA or your 401k, this is increasing your overall income. The IRS will take that into account when determining how much of your Social Security benefits are actually taxed. In fact, up to 85% of your Social Security benefit could be taxed. That's right. More than 3/4 of your Social Security could be subject to taxes if your total income is too high. So let's review that. If you look at this chart here, we can see that if you are single or head of household and make under $25,000, Social Security income is tax free. If you make between $25,001 to $34,000, up to 50% of your Social Security income is taxable. And if you make more than $34,000, up to 85% of your Social Security income is taxable. Now, these limits do increase if you're married filing jointly. If you make $32,000 or less, Social Security income is tax free. If you make between $32,001 to $44,000, up to 50% of Social Security income is taxable. And if you make over $44,000 per year, then up to 85% of Social Security income is taxable. And this is why it's so important to factor in the tax implications of both your withdrawals and the eventual taxation of your Social Security benefits. A strategy that works well for one person may not work for you if you don't account for how these taxes will play out over the long term. And the last thing you want to do is end up paying far more in taxes than you originally had anticipated. This could erode the value of your nest egg and your Social Security benefits. Now, on to point number 4, assessing your cash flow needs. Before you decide to delay Social Security and tap into your investment portfolio, there's one critical question that you need to ask yourself. Can your portfolio withdrawals comfortably cover your living expenses? This may sound simple, but it's actually one of the most important and often overlooked factors in your retirement planning. Your cash flow needs are at the core of how you navigate the years between retirement and when you finally file for Social Security. That is, when you claim Social Security. The first thing that you need to do is assess exactly how much money or income you're going to need to cover your day-to-day living expenses. This includes things like housing, utility, food, insurance, and healthcare. It's also important to plan for those unexpected things that pop up, like home repairs or medical bills. Now, if you plan to delay Social Security, it's likely that you're going to be drawing on your investment portfolio to cover your everyday living expenses, just like we talked about in point number 2. But here's the crucial part. Will your withdrawals from that portfolio be enough to actually meet your needs? And more importantly, can you do this without depleting your savings too quickly? That is, can your withdrawal rate be sustainable throughout your entire retirement? Some retirees have other income, like pensions, rental income, or even part-time work income, which can help bridge the gap between investment withdrawals and their living expenses. If you have any of these streams of income, you might find it easier to rely on your portfolio without drawing too heavily from it. But if you're counting solely on your investments, you'll need to make sure that you have a withdrawal strategy that's sustainable for the long haul. Ultimately, you're going to want to look at your total income inflows and your total expenses or outflows. Depending on your situation, you could have a positive net flow or a negative net flow. If you have a negative net flow, you know that you will need to cover this with some form of income. So if this is the case for you, delaying Social Security for a larger monthly payment in the future might not actually make sense. It may not give you the return that justifies how long you must wait to collect your benefit. In fact, drawing on your Social Security earlier could allow you to actually enjoy those benefits sooner and take the pressure off of your portfolio withdrawals. Now, again, this is completely dependent on your unique situation, so make sure that you have a plan in place before you do anything. The earlier you start planning for this, the better. Think about things like, where is my income going to come from and how long will my savings last based on my set assumptions. This will allow for you to make more informed decisions around when you should actually claim Social Security. The break-even point is absolutely crucial when it comes to filing for Social Security. The break-even point is the tipping point where the strategy of delaying Social Security finally pays off financially. And for the vast majority of people, this happens sometime in your 80s, if not your early 90s. And what does this mean for you? Well, if you want to delay claiming Social Security, you are sacrificing those early benefits in exchange for larger monthly checks later on. But of course, the question is, how long do you need to live for those larger checks to make up for the amount that you would have received if you filed for Social Security earlier? So let's break this down with a quick example. If you elect to delay claiming Social Security until the age of 70, you'll start receiving a much larger benefit at the age of 70. This also means, though, that you're going to miss out on 8 years of income that you could have been potentially earning. So let's get back to the break even point. Again, the break even point is the age where the cumulative total of those higher payments from waiting outweighs the income that you missed out on by not filing for Social Security at the age of 62. So, when is the right time for you to collect? Like I said, this usually occurs in your 80s and potentially your 90s for some people. Therefore, if you expect to live well into your late 80s or your early 90s, delaying Social Security could be the right strategy for you. Now, with all of this said, there's obviously never any guarantees here. This is simply a projection. And like anything else, that's why things get tricky. And with that, how will you decide when to collect Social Security? Now, it might sound cliche, but it really comes down to your personal situation and ultimately your health outlook for the rest of your life. The bottom line is this: by understanding what the break even point is, this will at least make you strategically think about when it makes most sense for you to collect Social Security. And like anything, there is no crystal ball or one size fits all to your ideal claiming strategy. Therefore, make sure that you have a plan in place, not just a general retirement plan, but a plan that clearly identifies your withdrawal strategy married with a clear Social Security strategy. And now, obviously, there's a lot more to consider here, but these 5 points should help you in deciding whether it makes sense to draw down your portfolio to delay Social Security. Again, it all comes down to your unique financial situation, your goals, and how long you ultimately expect to live in retirement. I hope this video helped you understand the pros and cons of drawing down your portfolio to delay Social Security. If you found it useful, please hit the thumbs up button and don't forget to subscribe to the channel for more retirement planning content. Again, my name is Zach Carruthers, and my goal on this channel is to empower individuals like yourself to embrace financial confidence and unlock the path to a life truly well lived. Thank you so much, and until next time, bye-bye.